Welcome to Financial Jaga Jaga.
Hi guys, welcome to today's episode of Financial Jaga Jaga, where I'll basically be explaining the impact of the recent increase in Nigeria's interest rate, also known as monetary policy rate. Yay! So I decided to make a video about this because it's a big deal. There's been no increase in Nigeria's interest rate for 6 years now, right? And the last time that any change at all was even made to the monetary policy rate was in September 2020, and then it was a reduction in the monetary policy rate, and I did a video talking about it. Now, it's too early for you to be lost. If you're already wondering, what's monetary policy rate? What's monetary policy committee? What's inflation? Please, I have a video explaining what all this means, and hopefully it should pop up here. I need you to watch that video so that you can understand why I'm even talking about this today. Now, this brings me to the topic of the day. So sometime on Monday and Tuesday, actually, the Monetary Policy Committee met, and then on Tuesday they released the result of deliberations, and one of it was that the monetary policy rate, also known as interest rates, was being increased from 11.5% to 13%. Now that was like, wow. A lot of people already expected the increase in interest rates. Like I said, watch my video, because Nigeria's inflation had been on the rise in recent times, and one of the usual responses of central banks in situations like this is to basically increase interest rates, and the belief is that it's going to encourage savings and reduce the money supply in the system. So people are arguing that, oh, but Nigeria's inflation is cost push, it's not demand pull. Watch that video again to get this gist. It doesn't matter, in my opinion. It's better than doing nothing. Yes, I agree that a large portion of our inflation might be related to cost, but it's better than doing nothing. At least you are able to reduce the possibility of this inflation worsening by putting some measures in place to encourage savings, reduce the level of demand, and potentially reduce the possibility of inflation galloping, right? So let's get right into it. Now that the rate has been increased, what is this? How is it going to play out? What do we expect? What should be the impact? What should this affect, right? So the first impact is that this is going to trigger an increase in the standard deposit facility rate and the standard lending facility rates, known as SDF and SLF. Now, please don't get lost. It's nothing deep. So, as commercial banks, at the end of each day, you do your books and you realize that you have a lot of money that is just sitting in your account. A bank can decide to go and place excess funds with the central bank overnight. So the central bank is going to pay the bank an interest, right? And then on the other hand, a bank might need funds urgently. And though this is not encouraged, right, the bank might have combed the market, called other banks to try to borrow money from them to no avail. They can actually go to the central bank to take funds from them, and this will come at a cost. Now, if you follow all of these monetary policy meetings, you would have seen something called asymmetric corridor, which stands at plus 100 and minus 700, right? Calm down. So what this basically means is that if a commercial bank wants to go and place money with the central bank, they are going to earn 13%, which is the current monetary policy rate, 13% minus 700 basis points, which means that 13% minus 700 basis points, meaning that if they are placing money in the central bank, they will be earning only 6%. On the other hand, if they are going to borrow money from the central bank, they will be paying the central bank 13% plus 100 basis points, which equals 14%. So you see, in other words, this is increasing the rate that commercial banks can take money from central bank, and the rate at which commercial bank can place money with central bank of Nigeria. Now you might be wondering, okay, I'm not a commercial bank, how does it affect me? If a commercial bank can borrow money from the central bank at 14%, what makes you think that they'll be willing to give you loans at a lower rate, right? So this brings me to the second point. Increasing the interest rate would lead to an increase in the commercial lending rates, right? So what I mean by that is commercial banks are going to have to increase the lending rates. So if customers or manufacturers go to them for loans, they will have to consider the fact that monetary policy rate has increased, so they would not be willing to, or should not be willing to, give out loans at the existing rate. So this should lead to, it should impact the lending rate. Now the third impact that we are likely going to see is an increase in savings deposit rate, right? So if you're going to be saving money with the bank, all things being equal, the bank should also take up the savings rate. So basically, if you've noticed this, I'm saying increase because the monetary policy rate is like the benchmark, is the base, is the rate that should determine all other kinds of interest rates in an economy, right? So the fourth impact we're likely going to see is increase in Treasury bills rate. I know. So I'm going to do a video talking as part of our investment series. Go and check that out, investment series, if you've not been following that, where I'll just explain where Treasury bills are, what Treasury bills are, and all of that. But for now, just know Treasury bills is a kind of investment, right, that you can do. You can lend your money to the government and earn sweet interest. So previously, or prior to this time, Treasury bill rates in Nigeria have been pretty low. But with this increase in interest rate, we should see Treasury bills rate rise, and in fact it has already started rising. So the funny thing is, so I'm a fixed income trader by profession, my 9 to 5, and I was able to see some of these things play out in the secondary market during the course of the week. On Wednesday, so this increase in interest rate was announced on Tuesday. On Wednesday, there was a Treasury bills auction, also known as NCD auction, and we saw, we all knew that, Treasury bills rate was going to go up. But the way the auction works is commercial banks or participants would submit their bids that, okay, I want to buy a 91-day bill, I want to buy a 182-day bill or 364-day bill at this rate. So you as a commercial bank, you as an auction bidder would place a rate that you think you want to buy those Treasury bills at. And previously, rates had been low, like I'm talking 4-point-something% levels. And when commercial banks went for the auction, or when participants went for the auction, the results came out, and oh boy. So we saw the Treasury bills rate increase. And when I'm saying increase, I'm saying it literally went up, like from 0 to hero, no kidding. So previously, the 91-day Treasury bill closed at 1.74, but at this auction, it closed at 2.5%. Then the 182-day bill, which closed at 3% before, now closed at 3.89%. Now, the 364-day bill that closed at 4.7, wait for it to closed at 6.49%. Now, come on, this is a huge jump we're talking about. And so I'm expecting that more people will be interested in investing in Treasury bills, given that at least this is like the first auction after the rate hike, and maybe in subsequent auctions we'll begin to see rates go up, or let's see the tempo that this is going to create. Now I don't even know what does it